Alright guys, Chapter 5, Economic Activity. Let's blow this up full size here. Okay. Objectives of this chapter: explain the concept of top-down valuation process, discuss the role of federal government in influencing economic policy, distinguish between the effects of fiscal and monetary policy, explain how inflation and trade policy influence the economy, describe the business cycle and how it relates to cyclical indicators, explain the relationship of the business cycle to various industries. Okay. Economic activity and business cycle. Okay. Business cycle and cyclical indicators, and stock prices and economic variables. We're going to dig deep into these in the next few slides here. Okay. So the top-down valuation process. So as it sounds, you're looking at macro analysis of the economy. So you're looking at the global economy, right? And saying, how's the global economy doing? Where are areas in the globe where we think there might be outperformance? And then when we go to those areas, maybe those geographic regions where we feel there might be outperformance, we'll then do an industry analysis of that region, okay? And then we'll look at common stocks by expected risk-return characteristics, combine surviving stocks into the portfolio assets. So we're doing some type of screening here. So we're saying, okay, well, we think out of all the countries in the world, these 20 countries are going to do best. They're part of our top-down analysis. Then we look at industries in those 20 countries, and then we might overweight those industries, and we might overweight specific stocks. So you're going from the top down. Pretty straightforward, pretty simple. Okay. The last part of there just mentioned, you change your view as time goes on. Your opinion today might be different than a month ago because of some major economic or political development. So you always have to keep an eye on your portfolio as well. Okay. Federal government and economic policy. There's fiscal policy and monetary policy. We can talk about the differences between those two. Okay. Government policy, real growth, and inflation are also discussed. Okay. So, federal government economic policy. Goals established by the Employment Act of 1946. Stable prices. That also means low inflation. We expect prices to rise, but only moderately year in and year out. They say 2 to 4% inflation is pretty normal. Anything higher or below that is out of the ordinary. Business stability at high levels of production and low levels of unemployment. Sustained real growth in gross domestic product. So we want to see the economy continuing to expand. I assume if you're taking this class, you know what GDP is, gross domestic product. If you don't, look it up. So it's a measure, yardstick of the healthiness of the economy. Generally, we like to see that growing. Will it grow every year? No, but in general, we like to see it expand. Balance in international payments, balance of exports and imports, as well as cash flows into and out of the United States. So ideally, you would want to see more exports than imports. As a rule, but there's things that can happen that will change that. There might be instances where the government wants to slow down the economy if the economy is heating up too fast, because there's negative consequences of the economy doing too well. For example, if the economy starts doing too well, what can happen is we can get very high rates of inflation. If that happens, the Fed might increase the interest rate. These are situations where the Fed will increase the interest rate in order to slow things down. Tame inflation. Okay. Right now, as a side note, we are more concerned with raising economic activity than we are about inflation. So what are they doing? They are lowering interest rates. So interest rates are close to 0% right now. Not for you and I, but for interbank lending. Okay. Employment Act of 1946. I wouldn't focus too much on this in terms of quiz material, but Council of Economic Advisors assist the President in implementing the Act. Joint Economic Committee of Congress review economic policy annually. That's pretty much it here. Okay. Percentage of change in real GDP, real domestic product. So we see some countries with growth, some with negative growth. Here we go. U.S. 4.1, 1.8, 1.1, 2.5, 3.6, 3.1. So then of course. 2009 here, we see a drop off, and this might as well be negative in 2008. We see the same trend here all over the world except China. China was China definitely slowed down, but they're still growing regardless of our situation. Also, Australia. I'd be interested to see why Australia, maybe their economy is so disconnected from ours that they felt less of an impact. Okay, fiscal policy. Fiscal policy, policy changes within the House and the Senate. Okay, monetary policies are policy changes at the Federal Reserve. Okay, so let's talk about this. Okay, fiscal policy tools. Okay, taxation and spending. Those should be the two key words you remember when you think about fiscal policy. Taxing and spending. Okay, the government can slow down the economy by raising taxes. Right, that almost acts as a regulator. Not always a bad thing. Taxes, they can be good or bad. It also raises revenue. Raises revenue for what? Well, so the government can spend. Government spending is actually a good thing. I mean, I know in the news right now, especially you hear about government spending being a very negative, tone on it. But the government builds a new parking lot at the MBTA. That's a 6-month project that employs hundreds of people. People get paychecks. These people who work at these kind of jobs, middle class, so they spend the majority of money. It flows back to the economy. That's the point of spending. There's good government spending. Will and should have far-reaching effects. It should employ a lot of people. It should act for the benefit of the economy. Bad government spending is, maybe like $1 million office renovation for one senator. That's, where our tax dollars are used. How many people is that supporting? How many people is that, providing an economic benefit to? Probably a handful of people. That would be bad government spending. And I don't think, I haven't heard of a case like that, but I just wanted to give you an extreme example. Okay. Monetary policy is policies enacted by the Fed, separate from Congress. So Congress and the Fed have, the right and the left hand of kind of our economy. The monetary policy is basically the Fed setting the money supply at a level where inflation will be moderate. They want stable prices. They don't want them to go up dramatically. They don't want to drop dramatically. They have usually some kind of targeted inflation. The Federal Reserve has a responsibility to maintain price stability and foster maximum employment. Those are their goals. You'll hear them talking about other topics. So below are some more details on the Fed. Okay. So some other tools they have is reserve requirements. This is a question in your homework, so if you're watching this video, I'm going to give you the answer. Reserve requirements for banks. Banks are required to hold on to a certain portion of their cash. They can't lend all the money they have out. That is set up, in a regulation. So let's say the reserve requirement is 20%. That means out of all the deposits the bank has, they have to keep 20%, for just their day-to-day business. And, if someone wants to withdraw money, they'll definitely have it. By raising the reserve requirement, the government restricts lending. By restricting lending, you're acting to slow down the economy a little bit. And that also works in reverse. So they lower the reserve requirement. It allows banks to lend more. And by lending more, hopefully the banks will profit more. Hopefully people will be more entrepreneurial or grow or whatever reason you take loans out for. Okay, the discount rate is basically the rate at which banks loan each other money to. In open market operations. That's the buying and selling of T-bills. So the government sells securities. Okay, when the government sells these securities by the quantity and etc., there's a lot more detail than I'll go into here. But they're basically setting the market interest rate by selling these government securities, right? And when the government sells a security, right, what are they doing? They're giving you a piece of paper and they're taking money out of the system. Right? So they're giving you this IOU, and then they're taking money out of the system. So when a government sells securities, right, that will act to what? Think about it for a second. When the government takes money out of the system by selling these securities, what are they doing? They're decreasing the money supply. And what? And trying to slow down the economy. But what you hear about what the government does now, or the Fed I should say, is they're buying securities. Why would they buy securities? Well, they'd be buying these securities in order to get more money in people's hands. They're taking these IOUs away from people and they're giving them cash. Why would they do that? they would do that to increase, stimulate the economy. Response to financial crisis, TARP. There's a nice explanation in the book about that. I won't go into too many details here for the sake of time, but basically TARP was an injection of money to the banks so that in theory they would lend more. Only time will tell if this was a really successful program, although I do think the economy is doing better right now, but there's a lot of factors that went into that. Okay. Government policy, real growth and inflation. So GDP, gross domestic product, measures the output and consumption within the U.S. in a given year. Okay, what we output, what we sell, and what we consume. Does not include products made by firms in foreign countries. So it only includes what was made here. So if we have if Apple's iPods made in China doesn't count towards us, is what's that saying. Consumer price index, that's what we measure inflation by, a basket of goods based on basic goods consumed by an average person. So when they say, inflation's up 5% or 2% or 1%, they're using the same basket of goods and looking at their price change over a certain amount of period. Now, that basket of goods can change on a bunch of things because of technology and stuff. It's not always the same basket of goods, but they keep consistency to it. The GDP price deflator is a broader, sorry, I'm having a hard time speaking tonight, broader measure of inflation than the consumer price index. We can go into detail on that after. Okay. Real growth and inflation, just a little chart here. It's in your book as well. Basic components of GDP. Personal consumption of expenditures, which accounts for more than 60% of GDP, then government purchases, gross private investment, and net exports. Okay. Consumer expectations are a leading indicator of economic activity. So if you think the economy is doing good, it's almost like a self-fulfilling prophecy. If the majority of people think the economy is going to do good, what are they going to do? They're going to be less tight with their money, more likely to spend, because they think that things are going to get better. So what happens? By increasing spending because of consumer confidence, things will get better because of that. But if the view is very pessimistic, then it works in the opposite way. Like, I think the economy is going to do really bad, so what am I going to do? Well, I'm going to hold off on that big purchase. I'm not going to buy that house this year, etc., etc. And it kind of is like a pendulum. It swings, so it gets to an extreme point, and then it flips and starts to go back. I think this year, and I've said it for the last few years, great time to buy the house. Prices are historically low, interest rates are low. I think, 5 years from now we could go back and we'll say, wow, you bought a house in 2012, smart move, Okay. Business cycles and cyclical indicators. A trough is the end of a recession and the beginning of expansion. So basically, when you're at the low point, that's the trough. Okay, peak is the top of the market. That's when things start to go down. Now, as you should know, it's not like the economy works in like perfect ups and downs. Sometimes there's a big up and a small down, and sometimes there's a big down and a small up, and then another small down and then a big up. So it's not a perfect system. A recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, employment, industrial production, and wholesale retail sales. They last for an average of 10 months. This is a strange definition. I've heard that a recession is, negative growth for at least 2 quarters. That's, in my opinion, the textbook definition of recession. Expansion is characterized by increasing real GDP, lasts for an average of 52 months. Okay, so it shows that the expansions are bigger than the recessions. Okay, so hopefully we'll be going into a big expansionary period now. Leading indicators, change direction in advance of general business, help indicate rising corporate profits and possible stock market increases. So if consumer confidence is high, that should be a leading indicator, right? Coinciding indicators move approximately with general economy, and lagging indicators usually change direction after the business conditions have turned around. So let's look at some of these, okay? This is too small, let you look at that in your book. Economic indicators, just going through more of these right here. There's a great slide here not there, here. Okay, leading index indicators, so average weekly hours worked, initial job unemployment claims, I should say, new manufacturing orders, okay, supply orders, other new manufacturing orders, building permits, stock prices, money supply, interest rate spread, and consumer expectations, consumer confidence. So if you see those start to rise, those are leading indicators, meaning the economy hasn't risen yet, but those are rising. You can assume that the economy is going to grow. And then coinciding indicators, okay, employment, payrolls, personal income, industry production, manufacturing and trade sales. Then lagging would be average duration of unemployment. So if we see low, for example, unemployment drops from 4 months to 2 months, that would be a good sign, but it's a lagging sign, right? You don't get those numbers right away. Average prime rate, commercial and industrial loans outstanding, consumer price index for services. So these are some lagging indicators. Stock prices and economic variables. The stock market is the most reliable and accurate of the 10 leading indicators. This is a problem if your objective is to forecast common stock prices. The stock market works on a lead time of about 9 months at peak and 5 months at troughs. Okay, interesting statistic. Okay. 3 economic variables that are very helpful in forecasting stock prices are money supply, GDP, and industry production and manufacturing. So once every couple months, there'll be an industry production and manufacturing report. The markets pay attention to that. So if they see a sharp increase in manufacturing or industry production, they think people are making new orders. Why is this important? Think about it like this. Another leading indicator that people have used, I heard, is like FedEx shipments. So if FedEx has dramatically reported an increase in shipments, what does that mean? Well, people are shipping more stuff. If they're shipping more stuff, they're probably buying more stuff. So things like that can act as indicators as well. Okay. Money supply, historically populated as an indicator of stock market performance. Studies have found long-term relationships between economic growth and the money supply. Same thing, GDP, strong relationship between the level of economic activity measured by GDP and the long-run movements of the stock market. A simple graph here of GDP, the S&P 500 and corporate profits. You can see that they move pretty closely in line. Industrial production and manufacturing. The ISM indicates expansion and contraction of manufacturing. Manufacturing is expanding when the ISM index is above 50. Capacity utilization is a really interesting ratio. It says measures current manufacturing output against potential output. So if we could produce 100,000 cars a year and we're only producing 60,000 cars a year, that means we're only at 60% capacity, which isn't, it's not terrible, but it's not good. But when we're at 90% capacity, that's a good sign. A sign we need to increase capacity, but a good sign, that's a problem with success. We can't keep our shelf stocked. And lastly, here's just some great websites on different economic data. So we'll end the chapter there. And please email me if you have any questions.